In conversation today with us, we have Harikrishnan S. He is a founder and managing partner of Blue Lotus Capital. Blue Lotus Capital is an independent global asset management and advisory firm with assets under management in excess of 330 million US, an active foreign institutional investor, FPI, in mid-caps across India and emerging markets. It has a global presence in India, US, UAE, and Singapore. Blue Lotus Capital serves institutional investors and family offices across the globe with the primary aim of generating superior returns using proprietary investment processes. Prior to this, he was part of the founding team at UTI Venture Funds, managing director at Avigo Capital Partners, and investment principal at Lazard India Private Equity. With over more than 2 decades of diversified experience in PE and PIPE, which is private investments in public equity, he has closed high-stake investments across various sectors, including healthcare, technology, consumer, and industrials. Welcome, Hari, to the Auxano Bytes podcast.
Thanks, Brijesh. Thanks for the kind introduction. Happy to be here to talk to you.
Thank you, Hari. And before we proceed further, a short disclaimer. This podcast is not for investment advice and is purely for knowledge purpose. Right, Hari?
Yes.
Nice. Let's start off the block. The Indian equity market has been an outperformer in 2022. The S&P index has headed south for 3 quarters in a row, which is a rarity by itself. Is this an indication for global investors to look at India more deeply and have an allocation in the portfolio?
Yes, Brijesh. I think global investors need to reset the India outlook now. What they had that outlook for the last 20 years, and the complete reset needs to be there for the next 10 years. I'll give you the various factors which aids this India growth story for the next 10 years. So if you take it from the demand side, right, we know that India current per capita GDP is around $2,300 US, and which we have been expecting to go to 4,200 by FY27, which is nearly doubling in 5 years. That's the big statement, right, from the country's perspective. And within this, also, if you look, the per capita income of an affluent people is moving from a $3,500 US to a $7,000 US in the next 4 years. This is around 250 million people. This is the one which is going to lead their India growth story, which is the domestic consumption story. This is a very strong population which going to propel the Indian economy to the next level. Another biggest India has an advantage today is a demography. The most young and aspirational population with an average age of 25-26 years who are going to lead the next 10 to 15 years of India's consumption story. And this is the population which needs the various kinds of services and products and other things at a global scales, right? So this is from the demand side of it. And let's see it from the supply side, which is also we need to take into thing. India also is today increasing their job opportunities on the skilled manpowers, right? Today, if you look, the traditional jobs creators like IT continue to increase the skilled labor force. The whole IT industry is expected to double the current workforce in next 4 to 5 years, which is a traditional which is continuing to go. What is the additional thing which has been going to add in the next 10 years is the technology enabled manufacturing, where we have been seeing that the PLI schemes, which is the biggest booster for the economy over the next 4 to 5 years, which is going to coming in. Another things which we also look into the technology enabled manufacturing. When we say that it's you are looking some of the thing non-traditional manufacturing like your semiconductors, the electronic manufacturing facilities, and another biggest the theme which is for the next 10 years is the decarbonization of the economy itself, right? So these are the technologies which are going to be led this manufacturing side of it, and which in turn going to increases your job creation on things. And then the third most important thing also, India is a digitization of their economy. India is the only country globally, if you look at that, such a young age population, when the penetration of the mobile phones is pretty high, and the usage of is also is pretty high on this thing. See, this digitalization is helping the lot of new services, and also goes to an untapped markets, which is going to aid the India's growth story. So what we are looking is that India in next 12 years, right, and achieving a $10 trillion economy from the current 3 trillion to a 10 trillion in next 12 years is most reasonable expectations. And it is also optimistic case scenario as well. From the global investors perspective, right, we are already sees this reset is happening very clearly, especially on the institutional investors perspective. One of the example I can give you is that Texas Teacher Pension Fund, in their emerging market portfolio allocations for FY23, they reduced the China weightage from a 35% to 17.5%, which is around 50% reduction. Whereas for India, from a 12.5%, they increased to 16%, which is a 30% increase. Oh, yes, there is a closer to 50% reduction in Chinese thing. The distribution also happens to the other Asian countries like Taiwan and South Korea also. But what India got today is a large portion of that reallocation. This is just one Texas Teacher Fund Pension Funds allocation. So if you look the same thing from the other institutional investors who are looking the long-term investments, we can see that this is the same, the scale which is everybody is looking in. So when institutional investors are moving in with this kind of an allocation increase and other things, I think this can be the same thing can be deployed by the family officers, HNIs, and even in case of individual investors as well.
No, taking from that in Hari, so the S&P 500 over a 3-year period as of 20th of October has delivered a CAGR of in excess of 28%. The BSE Sensex has delivered around 52%, but if you keep it in dollars, it is it's slightly higher than what S&P 500 has delivered. So Indian market in dollar terms has also delivered slightly higher than the S&P 500. But taking it forward, this on a 3-year basis, on a lower time frame, again, because of what has happened in US, we still are outperformer India as a market. One common note, as you rightly said, institutions have started putting, increasing allocation to India, and the individual investors or HNIs or family offices are still reluctant or slightly wanting to wet their feet. So one common question is constantly, which we hear, is that the Indian currency depreciates, and that's the one reason why I do not want to invest in India. And as a fund manager who invests predominantly in India, and with the EM which you have created over a period of time, how you would want to approach, and what are the let's say confidence building measures, I'll not say, but what confidence the past performance over the last 3 years and also the current performance should the prospect should take into consideration while allocating funds into India?
Yeah, this is one of the concerns which always we hear about from the global investors on the depreciation of a currency, right? This argument also has been true for the last 2 decades, right? Post the India economic liberalization onwards, we have been seeing that depreciation of our currency as well. We have to step back and see what happened to other countries when their economy has grew and how the currency has behaved, right? In that, to our size of the economy and things, we can't take Chinese and RMB because it's a pegged currency, right? The closest one, if you want to can take, is what happened to the Japanese economy and the Japanese yen, right? We all know that Japanese economy is around 1.1 trillion in 1980s, and from 1980s to 1995, that 15 years, where the Japanese economy has grew fivefold, right, in a 15 years time frame. And in that time frame, if you look what happened to the Japanese currency, right, from a 260 yen to a dollar in 1980, it has come down to all the way to 85 yen to a dollar in 1995 when the economy got peaked in that 15-year cycle. So in any economy, the initial years of economic growth is always in the hands of the government and their spendings, right? Which drew the economies from say 600 million to 1 trillion or 1.5 trillion kind of a things, and which is normally which the government during in that space government normally take care of the basic needs and the infrastructure requirements and all this thing, which will be funded by the mainly by the states, right? But once the growth has been fueled, once the growth has been brought into a level, then the next level of the growth is coming from the consumptions, right? The local consumptions or the exports and everything. That's just the time where the currency behaves differently, right? I think in our view, that's where the India is currently is sitting in. Where the first 20 years of the thing where the state funded infrastructures and there is a basic frameworks have been all put in. Now from here is what the next growth engine is going to be kick starting on this thing. In India case, another thing also we have to look is that the decarbonization of the energy needs in the coming years could save a substantial energy import bills, which is our biggest import component on these things. And in any growing economy and the kind of a foreign flows, especially through the FDI route, is increasing, which we also seen in India case also in last 5 years from a $30 billion of FDI inflows, we are already touching closer to $80 billion kind of an annual flow. I think in next maybe 5 to 10 years, we should see that doubling from here on, right? Another thing which is also another next 5 years, which we also looking is the increase in the merchant exports, which is mainly triggered by the PLI schemes and also the global global thinking of the distributor, the global supply chain strategies. These are the things which is also going to aid the India's the currency, how it is going to be behaving on this thing. Our take is that in next 3 to 4 years, we feel that the rupee would start appreciating against the dollar, and how it has happened in case of Japan during their growth phase, we may see the same kind of things happening in India as well, because even Japan also you've been seeing that it's been completely fueled by the exports growth at that time.
So a contrarian is what you're talking about, while others are talking about further depreciation, talking about appreciation.
Yeah. So Brijesh, on a shorter time frame, say maybe a next 12 months time frame or 6 to 12 months time frame, yeah, possibility is there that we may even depreciate from currently 80 to 83 onwards, and we can even go to an 85, 86 band also. But when I'm taking a next 5-year call, 3 to 5 year call, I think we will be much better off than the what we have been there in the last 20 years. And which that also been shown in the last 6 to 8 months during the global geopolitical crisis and the interest rate increase scenario. We are the one of the currencies which have been depreciated less when compared to the others.
Absolutely.
Right? Yeah. So that is also is another way of this thing, right? So from where we have been seen from the huge swings and the depreciations in the during the 2000s, and now if you compare it now that we are more or less the depreciation happen also is in a very orderly manner, and that's also is also aided by the very strong forex reserve which currently the country is having. I think that's also aids that stability in the overall fluctuation of the currency as well. So we have been from that if you take this scenarios and next 4 to 5 years, how these economic growing happening, both at the demand side as well as on the supply side, especially on the current account at the current account side, I think it is a very reasonable bet that appreciation of the currency.
See, till now we have, looked into the GDP growth, the currency part of it, the outlook, which is there for a decade. Now, let's say another common, or a question which comes in mind is that the stock markets and the economy, how much do they resemble? So, the last 2 years have shown, what is what. The same time, one question which comes in very deeply is that, is India immune, from the recession, or is it only a matter of time? And in 2023, what has happened globally, Indian markets, stock markets can also have some similar corrections, or it will continue to, move as a lone wolf forward.
Yeah, it's a good word to put a lone wolf. Yeah, so I address with you on this thing is on the stock market and the economy resembling each other. See, economy and market goes hand in hand over a long time frame, right? Say in 8 to 10 years time frame. In a short term, right, sometimes it diverges because due to the short term events which is happening globally, domestically, and those things. But eventually, over the next, if you take over the 8 to 10 years time frame, the stock market needs to reflect the fundamentals of the economy. Otherwise, there can't be too much a divergence between both of them. On your question on the is where we see a recession or a corrections, from the Indian economic perspective, we are not going to see any recession. That's pretty much we can have that very clearly on this. On the market correction, yes, we may see some corrections on the way. It's not ruled out, as the connected world is not completely insular to a global economic and geopolitical shocks. So there are sectors which have been linked pretty much to the global events and the global economy. And maybe that sectors maybe get in a shorter term may get affected. But from a domestic perspective, domestic consumptions as well as the Indian economic perspective, I think we may not see any recessions.
So we are the lone wolf?
Yes, possibly.
Touch wood for that, okay.
Yeah.
So having said that, so you have managed funds globally, and recently you're also managing now India-centric at 3IF. So how do you look at the domestic investors versus the international investors approach?
There is a very clear difference between both the investors group. Domestic investors, most of our domestic investors actually has a lacking the a limited opportunity to invest in various asset classes. So it's been very clearly bracketed out in one or two large asset classes. I'm keeping away the gold away as such because that's what's traditionally Indians used to invest. If you look other than that, either you have an equity or a debt, and the third is a real estate. It's pretty much, and that's most of the thing, all are domestic focused things. So the domestic investor has a very limited opportunities on the asset side. There are very few strategies which has been again and again played out by all the players. Even as you rightly said about the category 3 hedge fund category in the AF, but you can apply the various strategies there, but still the taxation is different from say in other asset classes. So once again, that's becoming a big issue from the domestic investors perspective on the taxation side and the AF. That's on the asset side of it and the different products availability. The biggest thing which I see a difference between the domestic investors and the global investors is that our domestic investors are look for a capital appreciation with a slightly taking a higher risk. The risk-taking ability is pretty high. Whereas the global investors look for a capital preservation with a medium to low risk portfolio allocations. So that's a big difference. So what may sells to domestic investors which may not able to, you cannot create the same kind of a portfolio for the an offshore investors, because the risk reward expectation is completely different from an offshore investors perspective compared to our domestic. And similarly, offshore investors also is that the India allocation is just a small portion of their overall global allocation. So so that way they have their own risk return metrics and which they follow something. So which is predominantly towards the capital preservations.
Nice. Quick for that. So an institutional investor globally would take a risk house approach, but a HNI or an individual investor, would like to take a more higher risk approach in Indian markets, or is it the same mentality which works across?
So that once again depends on the once again the age profiles and the kind of the capital allocation they are looking in. Because if someone is looking at emerging market allocation, and within the emerging market allocation, how much you need to go to in India, and within that India, whether you want to be in the listed side or you want to be in an unlisted side, in the alternate asset classes like VCs and PE. So there is some multiple, once again, you need to classify on this thing. From an institutional perspective, the quantum of money in each buckets will be, it's meaningful. So from an individual investor's perspective, how that is going to be play out. Say if someone is having $1 million, how much you will be going to put it in some asset classes, which is going to be an illiquid ones, some are they going to be liquid ones. So that going to be, once again, depends upon what the individual investors is looking from his own perspective. From an individual investor's perspective, he may try to take a larger risk, try to capture the India story much better than an institutional thing which goes by their own frameworks, like as I given the example of a Texas teacher fund kind of a thing. So an individual investor can go from a 2-3% allocation straight to a 7-8% allocation overnight, but an institution can't go. Right, so they have to go step by step. So in that way, there is a flexibility from the individual investor's perspective. If they believe in India story, and I think they should allocate more to India portfolios.
This is music to in my ears personally. See, a certain dichotomy, if I say that, you are a pioneer in venture investing, in late 90s, part of UTI venture funds, private equity is what you came in big time. And today you're managing predominantly in the public markets. So how similar and how different both are?
I think basic fundamentals of equity investments are same for both, right? Both are two sides of the same coin. I don't think there's any difference between a public or private, right? What is the common thing, right? When we look from us an equity investors, when we look for a good business, right? A great promoter, and a decent valuation of that asset class when you're entering, right? That's where we're looking at. So this is it's same for whether it is you are investing in a private or a public. That's going to be the a common in this end. Yes, as a VC, we take the higher level of risk, right, when compared to a public market, where you look for more of a matured business, and then you bet on the growth story kind of a thing. Whereas at a VC level, you may go at a concept stage level, and then you bet it on the, then you will grow it along with that thing. So yes, at that risk level, there is a difference. And obviously that is also has been compensated by the return as well. All right. So that's that where, that's where the difference comes into place. Otherwise, when you're selecting the companies, when you're looking for the businesses, every other things are going to be the same. Between both of things, another thing is a common, I think, is the exit, which is the most important. Whether it is a public or a private, you need to have a great exit. So I think so in that way, while you're investing also is it's going to be the same, and your exit also in both the cases are the same. So I think if you have a great a framework on evaluating the companies and when to exit, I think both are same.
You played the diplomatic path. I'll not push you more there. Fine. Now, again, coming to global investing, how much, you talked about allocation of the portfolio, but still, being very specific now, how much in for the next 10 years, if you want to allocate to India markets, and you talked about how, the weightage to India is increasing, but someone who is starting out now, what would the allocation would you actually recommend for global investors?
Yeah, Brijesh. So look, today India's market cap to a global market cap is around 3.5%, right? So if any investors want to allocate to India, at least you have to start with the minimum 3.5%, which is in line with what the global weightage is, right? And more or less the same figure also is the same to the GDP, to global GDP to India GDP. It's more or less the same, 97 trillion, GDP with India to 3 trillion. It's more or less same 3.5%. This comes into the, whether you take it from the GDP economy perspective or you take the market cap perspective as well. That's your baseline, right? 3.5% is your baseline. Then you come and look the growth of the country, both at the economy as well as the market cap level, how one you're going to see for the next 5 to 10 years on this thing, right? If you take that in taking that in context to the global economy, where that is going to be grow, and within that pie where the India is going to grow, right? So in that, if you take that as a scenario, then reasonably you can go to a 5 to 6% from a global asset allocation perspective, right? So the baseline is maybe a 3.5% is your baseline, and the midpoint maybe a 5 to 6%, because that's what in next 5 years you are going to anyway going to reach there. If someone wants to take a really an aggressive bet on in India, where they want to reduce the other emerging markets portfolios and look only India, maybe other couple of other Asian countries, then you can go all the way to a 8% kind of thing, 8 to 9% kind of a thing.
And I think this helps, someone who wants to starting out and listening to the podcast, to starting with the benchmarks, and then based on the conviction can move forward. And
Yeah.
over the 5-year period, you can also get into a double-digit kind of an allocation.
Yes, absolutely possible. Yeah.
Fantastic. This is good news to a whole lot of global investors who are looking at opportunities, to put money.
Right.
Now, something on a different note, so you have more than 3 decades and 2 decades here. And so what are, key learnings, if you say, I would say key, if you can say first, 3 things which has remained constant, like nothing over the year journey, 3 things which you said has remained constant and just guided you.
What has remained constant? The greed of the investor is the same. So that's not going to change.
Okay.
And always look for another 1% more. Right. So it's a constant factor. The emotional quotient of an investor, I think it's a constant. The pendulum swings, the emotional swings. I think that is we can read, we can listen, we can do whatever you think at that emotional level, either on the decision making process or reacting to the events and other thing. I think that emotional quotient is becoming it's not changed, and actually it is becoming more and more. Actually, the intensity, the more the noises we are hearing, the emotional thing is becoming much more. The swing of the pendulum is becoming much higher now on that things. So from the basic perspective, yes, that emotional quotient has not changed at all. Another thing is that uncertainty of the future, right? We can do all kinds of theories and other things. We need to also accept that there is a limited then known unknowns and unknowns, right? So that's where the thing, even though investments is all about predicting the future, but by itself is an unpredictable, right? So I think this is the basic of any investors, which includes even a fund managers. I'm not saying it's just a thing, even more so for institutional investors becoming much more and more. It's a rigid thing is continuous, right? So I think this, I don't know whether I addressed it to your thing, but I think this it's continued to be the constant for maybe next to 2 decades also.
So when you said greed, I thought you would say fear also, or does fear comes under the emotional quotient?
Yeah, it will come on the emotional side of it, right? So greed and fear swings on the both side. Yeah.
So you said what has been constant, what has changed? Three things just changed.
Oh yeah, there is changes has been a lot actually, and one thing which we can see that is the democratization of the information and the data availability, which is what used to be the what you say the forte of the institutional investors. Today that has been today democratized, right? Today the same information which is getting flashed is that available for everybody at the same time, and the same kind of an analysis has been there. You're getting at the same level what an institutional investor is getting, and today what a retail investor is getting. It's absolutely it's same. All right, that's the big change, and that information inefficiency has been pretty much been taken out on that thing. Second thing, also if we look access to the various markets through the technology enabled platforms and other things. Today, we are able to go outside India to looking for the investments. And so that's another thing which has been very clearly, even 10-15 years before, you're not even think on that, like whether we can buy an S&P 500 or buying a Tesla or buying an Apple. It's completely changed on that thing. So that's a pretty good changes on this. And a third, if you look from in India's equity markets, there's a pretty good increase in the breadth and the depth of the Indian markets, and that's very positive news. So we've been seeing in last 12 months 30-40 billion dollar of FI selling has been completely absorbed by the domestics, right, without even damaging much to the indices. And even we have seen that in the VCs and the private equity funds getting the exits. That's the big change today. Like even day before yesterday, the Bain Capital has exited from Axis Bank and thing. So now there is a huge confidence from the VCs and PE guys also that you have a real depth of the markets where you can able to get an exit. And that's a very big change which we have been seeing in that. And I think these three things has really been changed in last, at least I've been seeing in last 2.5 decades on this.
I think, Hari, I agree with that, because the democratization of information has helped, a lot of SMEs also to be at par or get that additional advantage or additional alpha, and asset allocation opportunities and exit is what everybody looks at. And sometimes you may sitting on a lot of potentials winners, and exit opportunities is something which is very interesting and engaging. I think this chat, can go on and can never come to an end, but I know you have to run. And one last cue before you carry on. One unfiltered piece of advice you have received in your career, which has changed your perspective or has given you direction which you never thought of.
Actually, I have come across a concept of first principles of thinking, which really changed my outlook towards the investments and the life as overall. Right? What's the first principle? A first principle is basic assumption is that you can't be deduct any further, right? Like in a theory, the first principle thinks you requires you to dig deeper and deeper until you are left with only the fundamental truths of a situation, right? And actually, if you look, this is what Aristotle 2000 years before, he defined the first principle, um, the first basis from which the thing is known, right? That's where the foundational or the fundamental of the thing. And I think that's a very, very strong and powerful concept. In a practice, we don't have to simplify every problem down to say on an atomic level to get the benefit of this first principle thinking. All we need to do is just need to go one or two levels deeper than the most of the people, and you will see that different solutions present themselves, at a different layers. I think that applies not just only for the investments, and I think it can be applied to across various aspects of your life and every other things of your things. I think there's a very, very powerful concept which has been I've been very fascinated, and I've been trying to start, at least the last 3-4 years started practicing this. I think it's a very, very powerful concept, and I think it really gives you a real direction.
Thanks, Hari. This brings to an end to our podcast. And Hari started with things elementary, and he has continued to remain elementary, through the course of the chat we had, and even closing remarks were also very elementary. I think being elementary is a very difficult part of the whole journey. But Hari, you inspire us, and that can be great for us. And sharing your insights on why investing in India today is a great opportunity, and one should not miss out. You are resonating the lone wolf story, or the time will tell. But yes, thanks, Hari, for your time. And
thanks, Brijesh. It's a wonderful discussion. I love to have more time, but I think we had a good time on this thing. Thanks a lot.
Thanks, Hari. Cheers.
Cheers.